Welcome to The Explainer. Today, we're diving into a genuinely revealing moment in the energy sector, Innio Group's highly anticipated Q2 2026 earnings report. If you follow distributed energy, you already know Innio is a powerhouse, literally, delivering decentralized power solutions all over the globe. But here's what makes this specific report a must-read. It's their very first earnings announcement since their IPO just closed on June 5th. We've got a ton of complex numbers to unpack today, a really fascinating financial mystery to solve, and some massive industry trends to uncover. Let's get right into it. Okay, so let's kick things off with the first massive number that just practically jumps right off the page. $2.3 billion. That is INIO's Q2 equipment order intake. To put that into perspective for you, that represents a jaw-dropping 316% surge compared to the exact same quarter last year. It's actually so large that in this single quarter alone, they've already crushed their entire full-year order level for 2025. I mean, that shows some undeniable momentum across their data center, power solutions, and compression business lines. But then, you turn the page of the earnings report, and you see this. Negative $16.9 million. That's Innio's Q2 GAAP net loss. For context, back in the second quarter of 2025, they posted a net income of over $62 million. So we're looking at a pretty sharp drop into negative territory on the bottom line. And that stands in stark contrast to those record-breaking multi-billion-dollar orders we just talked about. Which brings us right to the central financial paradox of this whole explainer. How exactly does a company lock in $2.3 billion in record orders, experience absolutely massive top-line growth, and still report a net loss for the quarter? It's a fantastic question, and honestly, it's exactly the kind of accounting mystery that makes digging into these financial reports so incredibly fun. Section 1. Solving the mystery. IPO costs versus real profitability. So if we look closely at this financial reality, it really splits into two totally different lenses. On one side, we have that GAAP net loss of $16.9 million. GAAP, as a reminder, stands for Generally Accepted Accounting Principles. It's basically the standard rule book. But that GAAP number, it was heavily dragged down by $81.2 million in one-off costs incurred specifically for their initial public offering and getting ready for the public markets. Because let's face it, going public is incredibly expensive. Now, if we look at the other side, we see the non-GAAP adjusted EBITDA sitting at a highly profitable $172.3 million. And this number represents the true day-to-day operational profitability of the business when you just strip away those temporary one-time corporate expenses. Let's just make sure we're completely clear on what that means. Adjusted EBITDA is defined by the company as net income adjusted for taxes, interest, depreciation, and, crucially for Innio this quarter, IPO costs and other non-operating items. So the big takeaway here is that when you strip out the millions spent on lawyers, bankers, and all that public readiness stuff, the core business engine isn't losing money at all. Actually, their adjusted EBITDA grew by 20% year over year. It reflects this continuous profitable growth and some really balanced investments in ramping up their manufacturing capacity. The core business is thriving. They just had to pay the hefty toll of entering the public markets. Section 2. The AI infrastructure power drain. Okay, so now that we know the core business is highly profitable and growing, we really need to shift our focus to the why. What exactly is the catalyst behind that crazy 316% surge in equipment orders? Well, the answer lies in the ongoing tech revolution. Dr. Olaf Berlin, the president and CEO of INIO, stated in the report, a highlight for the quarter was a landmark 1.1 gigawatt order for prime power for a data center operator, reflecting customers' confidence in our technology, execution capabilities, and ability to scale. What we're seeing here is the direct financial impact of the massive AI infrastructure buildout. You know, artificial intelligence requires incredibly power-hungry data centers. And since the traditional electrical grid is so often constrained these days, it's fueling an urgent, undeniable need for reliable, decentralized power that companies can just generate on site. And NIO is perfectly positioned to provide exactly that. But this growth extends way beyond just one single order. Check out these key business wins. Alongside that massive 1.1 gigawatt data center order, they also secured a multi-year strategic framework agreement with Relco to supply about 1.25 gigawatts of gas engine capacity over the next 3 years. Plus, they're aggressively future-proofing their technology. Innio just completed an industry-first demonstration of 100% hydrogen backup power at the 3-megawatt scale. And they didn't do this in a vacuum either. Technical experts from tech giants like Microsoft and Google were literally there to witness this live testing, to assess it against real-world data center requirements. So they are quite literally proving they can power the AI future sustainably.
Section 3. How INIO makes money. Equipment versus services.
With all these massive orders pouring in, we need to look at exactly where their $937.7 million in total Q2 revenue actually came from. Total revenue, by the way, was up an impressive 42% year over year. Now, the top line is split into two main engines. First up is equipment revenue, which brought in $569.3 million. That's a 61% growth year over year, really driven by the disciplined execution of their order backlog, especially in that data center space. But you definitely don't want to overlook the second engine, services revenue, coming in at $368.4 million, which is up 21%. Why does this matter so much? Because once Innio sells the equipment, they sign these long-term service agreements for spare parts and maintenance. This creates a highly resilient, high-margin, recurring revenue stream that spans the entire lifecycle of the equipment. It's just a fantastic, beautifully balanced business model.
Section 4. Zooming out. The road to 2030.
We've spent a lot of time looking at the current quarter, but what does the future hold? The company is currently executing this huge multi-year capacity expansion plan across both the US and Europe to meet this accelerating demand. And that leads us to another massive metric, $6.6 billion. That is INIO's equipment order backlog at the end of the second quarter. To really give you a sense of the momentum here, that is an increase of 279% year over year. I mean, at the end of Q2 2025, it was just $1.7 billion. To be super precise here, equipment order backlog is defined as booked new sales orders for the equipment segment that just haven't been fulfilled toward the customer yet. So basically, it's a massive stockpile of guaranteed future work. Having $6.6 billion in the pipeline is absolutely critical because it gives the company some incredible revenue visibility. Based on their expansion plans and their current production capabilities, Innio believes this backlog provides strong revenue visibility that's going to extend at least into the year 2030. It completely de-risks their near-term future. And honestly, we can already see that backlog translating into near-term financial success. Because of their strong first-half performance, INI just initiated their fiscal year 2026 outlook. They're projecting total revenue to land somewhere between $3.8 and $3.9 billion for the year, with adjusted EBITDA increasing to between $720 and $740 million. For comparison, their fiscal year 2025 total revenue was $2.6 billion. So they're actively utilizing their expanding manufacturing capacity to just chew right through that backlog, turning those orders into recognized revenue and profit right now. As we wrap up this explainer, I want to leave you with a slightly broader thought to chew on. Innio's incredible Q2 numbers, that 316% surge in orders, the $6.6 billion backlog, these aren't just numbers on a spreadsheet. They are a direct reflection of a rapidly changing world. As AI data centers multiply and overall electrification accelerates, our traditional energy grids are facing totally unprecedented constraints. Companies are literally being forced to take power generation into their own hands, behind the meter. So the question isn't just about Innio's profitability anymore. It's really about the future of our entire infrastructure. As this insatiable demand for decentralized, hydrogen-ready power continues to grow, how exactly will the global grid adapt? It's a massive transition, and we now have a very clear view of exactly how it's playing out on the balance sheets. Thank you so much for joining me today, and keep learning.